Greetings from Nabo Capital. My name is Mercy Njoroge Mwangela, and we're continuing with this series of treasury solution where the content that we're bringing is about how can you generate passive income line from your business. What will passive income do for you? It will not only help you to build your wealth as a business, but it will help you to optimize your cash flows, generate an additional business line, which is called the investment income line, and thereby providing financial security and stability for your business. In this series, our CIO will be unpacking the investment art of how we execute a treasury solution. Tune in, log in, continue to watch this content. If you like to receive our newsletter, email invest@nabocapital.com. Thank you for joining. So value at risk is one of the measures.
Yeah.
I had, within value at risk, is there an element of stop loss?
Yeah. So they kind of feed into each other.
They kind of feed?
Yeah.
Okay.
So value at risk, if you say you have a value at risk of say 10%, then in essence all your stopgap measures should be below the 10% loss to make sure that works. But the way value at risk works is it's based on the composition of the portfolio. A stopgap measure is how I would describe it as pulling the wire out of your PC, pulling the power plug.
Okay.
Yeah.
Got it. Thank you for that. At Nabo, I've had you speak numerous times in presentations for institutional clients about Taylor rule.
Yeah.
What is Taylor rule from a monetary policy guidance with regards to treasury solution?
Yeah.
I like what you said. Portfolio management and risk management boils down to two things: inflation and GDP. So with the Taylor rule, where does it originate from? I know from the US. And how does that segue back home to Kenya? And what are you seeing right now from an opportunities perspective? So that's like a three-stacked question.
Yeah. Let me get the whole stack. So the Taylor rule was, I think it was the 1970s, 1980s. And it was essentially took into account GDP growth. It took into account inflation, and then it took into account the targeted inflation rate of the central bank. So without getting into the nitty-gritty of it, it's basically a model that allows you to figure out in a smooth way, and this word is really important, smooth, where the risk-free rate should be going to keep inflation under control. So if you applied that rule back historically, what you'd noticed is it's not been applied over the last 10 years. But that's not a knock on the Taylor rule. I believe almost every serious central bank publishes data on the Taylor rule, where the rate should be relative to the rule. In fact, if you just Google it, it's one of the first things that pop up. So a lot of central bankers actually benchmark themselves on how good the job they've been doing by using the Taylor rule. So that's important. The opportunities you see when the Taylor rule makes wild swings is something similar to what we did in around 2022. Well, a combination of factors and the risk-free rate rising due to inflation, we were able to bag certain Eurobond positions that generated around 33% in USD after tax, which is pretty good for a bond investment. But then switching gears, this will get into economic theory a little bit, but the simple way to understand it is if your risk-free rate goes down, right? Then, and your return on risky assets is a combination of your risk-free rate and the premium, the risk premium, well, then your return on risky assets has to come down to your expected return, right? Are you with me so far? I know this is just...
It's getting technical. I'm waiting for the example.
Yeah. So it becomes, next part just kind of ties it all together, right?
Okay.
So an equity can only do two things. Its price can either go up and its price can either go down. So if the Taylor rule says that the risk-free rate is going to fall, and our models tell us that means that the future expected returns of stocks is going to fall, the only way for that stocks to go to that economic state is if the stock price rises. So when the risk-free rate goes down, you buy stocks, because the only way for a stock to limit further upside is for the price to go down. Price to go up. Well, yeah. So yeah, that's one reason why I would really like the Taylor rule. Helps you capture a lot of different asset classes. And then of course, let me just mention in passing, if your risk-free rate goes up, corporate bonds, government bond rates all go up. So that's also something we did last year to help mitigate risk for our clients. We essentially sold everything in the farm ahead of the rising yield environment. That really saved our clients a lot of pain in terms of capital losses. Yeah.
Correct. I recall for one particular client where we did a significant Eurobond allocation. That client was able to return a 33% on that particular portfolio in dollar terms. So I think what Damitha is saying is we not only just look at the typical risk frameworks, we also apply the Taylor rule, where we're looking at the risk-free rate of Kenya, we're looking at the Fed rate, we're looking at Kenya's risk-free rate, and what does that really mean to the portfolio and the various asset classes? Equities, fixed income securities, local, and at Nabo we're an African investment house. So some of the securities and opportunities that we look at are not only concentrated in Kenya or East Africa, but we invest anywhere from North Africa, Egypt, all the way to the borders of South Africa. And South Africa, that's a different story. So we diversify the portfolios, we bring opportunities to our investors, we work with our investors to help them generate a better return. We recommend assets that we feel are doing better. So for this particular client, actually for all the clients, we did recommend a dollarization in the Eurobond strategy once we assessed where the Taylor rule was playing. And some of them said yes, the ones who were bold enough made a significant return, but this is the value that we bring into you as a CFO. This is what we do. This is what we wake up to do day in, day out. We're looking at the macroeconomic environment. We're applying various metrics and various models in assessing and identifying opportunities, but also in looking at securities that we've invested in. So we're actively able to move in and out of positions, hence the treasury solution being an actively managed portfolio as opposed to a passively managed portfolio. I think as we close, Damitha, thank you so much for your sharing. A lot of insights here. This is like really deep content. Please speak through your fixed income investment philosophy. There's one that you apply. Very briefly, what are some of the characteristics that you look at when you're assessing, do I invest in this corporate bond, do I invest in this government security? I know you moved out of Uganda last year.
Yes.
What was one of the triggers for that when you're looking at your investment philosophy?
So we have an investment philosophy called the 4Cs. And that's our investment philosophy. But what really got us out of Uganda was our investment strategy. And it's kind of important to delineate between the two. So what our strategy from 2021, 2022, early 2023 was really based on was that we were seeing the risk-free rate rise. Now, if you see a risk-free rate rise, that must mean that the yield on your bonds must also go up and up and up and up. And bond prices has an inverse relationship with yields. So what this created was a situation where we were really only targeting, let's say, Kenyan local currency bonds after they hit around 18%. But that risk-free rate also informed our corporate paper decisions. So I think it was sometime November of last year. You're going to have to correct me. Yes. Yeah. Where we pushed all our corporate paper partners to quite an attractive rate. And that was based, of course, on the investment strategy that where we knew the risk-free rate was going to go up. For Uganda, and I'm looking up to it, it was more of a ethical consideration. You know, I'm not from Kenya, definitely not from Uganda. But I think, you know, people have the right to choose whatever government they want to represent themselves. But, you know, as, especially at Nabo Capital, where we put ethics at the forefront of so much of what we do, you know, what transpired at that period just didn't sit right with us, with our ethical framework. So there wasn't anything in terms of investment philosophy or strategy that really said, oh, you know, we're going to short Uganda. It was just that, you know, it didn't sit well with a fungible, admittedly ethical framework.
I hope this has been an amazing conversation, life-changing conversation to be precise. And I hope that this message gets to as many CEOs, CFOs, general managers, and business leaders out there. And for me, there is only one challenge that I want to throw to all of you who are listening my voice. How much investment income do you have amongst your revenues? What is the percentage of investment income contribution to your revenues? And I would say this, every business needs an investment income line. So I want to say, if you feel this speaks to you, please reach out to us at Nabo Capital. We will be more than happy to sit down with you to explore all the options, all scenarios, and come up with a plan of how we can optimize your investment income line. We can introduce an investment income line to be one of the contributors to your revenues and insulate your business from the turbulent times that we live in. Thank you very much for listening to me. I look forward to engaging you further after this conversation. Thank you, and God bless all of you.